Okay. Good morning, everybody. Thank you for joining us this morning. I'm Nat Nason with Nason Yeager. Also on this webinar with me today, my partner Dave Gellin and our associate Constantine Christakis. And in addition, we have Dave Thomas from the CPA firm of Hollyfield and Thomas. So I'd like to thank all of you guys for being with us today. And for those of you who have joined us, we're in pretty uncertain waters right now. And one of the things that we're trying to do by way of this seminar is to let you all know, more about the federal programs that are out there for you. And the structure of this webinar will be essentially, we're going to take you through a PowerPoint, and we're going to try to get through those screens pretty quickly in order to allow time for questions. So the way you would submit a question to us is on your computer or your portable device. There should be a drop-down screen, and there'll be a chat box that you can get to, and you can submit a question in that chat box, and we will do our best to respond to those questions, get to as many as we can during the course of this seminar. If you can't get through that way, you can also email me at nnason@nasonyeager.com, and I will have the ability to also look at questions as they come in. But we'll deal with those towards the end of the seminar or the webinar, as opposed to during the course of it. So with that, once again, welcome. We're going to try to get you, through these turbulent, troubled waters as best we can, give you guys some tools that can help your business stay afloat during these time periods. So for an overview of the Paycheck Protection Program, Dave Gellin, I'd like to go to you to kind of kick us off a little bit.
Sure. Thanks, Nat. Good morning, everyone. As everybody is aware right now, through the CARES Act, there has been the Paycheck Protection Program that has been provided for gives for forgivable loans of up to $10 million to eligible small businesses. It's administered, as I said, by the Small Business Administration, and it's going through private lenders. The loan amount is based on the average monthly payroll costs, which we'll get into a little more detail as we get into the webinar this morning. It's available to businesses and nonprofit organizations with less than 500 employees, subject to the SBA affiliation rules, which we'll also discuss further. It's available also to independent contractors, sole proprietors, and certain self-employed individuals. And the proceeds can be used to pay for, to cover payroll costs, mortgage interest, rent, utilities, and interest on certain debts. The loan forgiveness is based on expenditures for certain uses over the 8-week period from receipt of the loan. And we'll get in a little more detail as we go through the presentation.
Okay, thanks, Dave. Constantine, can you go to the next slide? It'll be slide 3, and talk to us a little bit about eligibility, size, and affiliation rules.
Yeah, so the applicants who might be eligible, the eligibility is determined based on size. So you're going to be looking at either having no more than 500 employees or no more than the SBA size standard for the particular industry. And we include a link there for the SBA website where you can look at your industry size standard. When determining the number of employees, you are going to look at affiliates as well. SBA has affiliation rules based on whether there's control between entities, and it might also be triggered when there's common control between a third party. And also note here that for the Paycheck Protection Program, the affiliation rules are waived for businesses with industry code beginning with 72. That is accommodation in food services, and when they have multiple locations and not more than 500 employees at each location.
Okay, thanks, Constantine. Dave Thomas, can you briefly go over the loan term guidelines for us?
Yeah, so we're going to see that the loan terms here offered in this program are extremely favorable for businesses, notwithstanding the fact that a good portion, if not all of it, could be forgiven entirely. But you'll see that the rate of interest that applies to this loan is just 1%. They are going to defer the payment of any principal or interest for 6 months, although we need to be aware that interest does accrue during the time frame. They're going to have a 2-year maturity date. So from the time you take the loan, the maturity date will be 2 years from there. But unlike other traditional SBA program loans, this one's really attractive in that there's no prepayment penalty. No collateral required here, and no personal guarantee is required for the 7A loan.
Okay. And Dave, if you would, can you continue your discussion about loans and tell us a little bit about the loan amounts?
Yeah, so the mechanics of this loan are as follows. You're eligible to take the average of the prior 12 months of payroll costs as defined. And when you get to that number, so you're going to get the total for each of the 12 months preceding the time of the loan, you're going to determine the average of that, and you're going to multiply that by 2.5. That's a very simple calculation that goes on the form application itself. That's going to be the loan amount that the institution is going to be examining. So this loan amount could include a prior loan that's received under the SBA's EIDL, or Economic Injury Disaster Loan Program, if you have something like that. As David was talking about earlier, the loans are capped at $10 million. And as we'll see later, that sort of reconciles with about 500 employees that would have no more than a $100,000 a year salary. That's about how they get there. We'll see more about that later. You also need to be prepared to have appropriate documentation, both to request the loan and to request forgiveness from that loan later on. And that documentation is going to include typical things like payroll to verify the amounts that are expended. And you should also have all sorts of payroll documentation, W-2s, 941s, your payroll registers if you use a separate payroll provider is also good documentation.
Okay, thanks. And Dave Thomas, let's talk a little bit about payroll costs and what kind of costs are eligible for inclusion in the calculation.
Okay, so when we were talking about deriving those monthly payroll costs, it's going to include salaries, wages, commissions, tips. We're going to simply run that for each month for your employees. You're going to include any paid benefits such as vacation, family leave, sick leave, medical leave, not accrued, but actually paid during this period. You're also permitted to include group health insurance that you pay for employees. So that's not going to be the employee's share of any policy, but it's going to be what the employer remits. State and local employment taxes. So for Florida, that's pretty much going to be the reemployment or the SUTA tax. And retirement benefits. So if you contribute to somebody's 401k as a match program or something like that, that's also included. You'll see a bullet point there that talks about independent contractors, sole proprietors, compensation, and so forth. All of that is to be capped at $100,000 per year as prorated for the covered period. So folks who are going to make in excess of $100,000 in a year are going to be limited to that $100,000 amount. People who are salaried or commissioned for less than that, their full pay would then be included.
Thanks, Dave. Dave Gelland, can you tell us a little bit about the allowable uses of the loan proceeds?
Sure. So for purposes of the uses of the loan proceeds, you can use them for payroll costs, interest on mortgage obligations, rent, utilities, and interest on other debt in place before February 15, 2020. If we move to the next slide, we'll see that there's a distinction. I think there's perhaps we're getting a lot of questions as to what you can use the funds for versus what you're allowed to get forgiveness for. And so while you can use the proceeds as described on the last slide, you can seek forgiveness for the applicable period, which is the 8 weeks beginning on the date the loan is received. Forgivable expenses during the applicable period include payroll costs, interest but not principal on mortgage obligations incurred before February 15th of this year, rent and utilities which were in place before February 15th, 2020. And the amounts attributable to the interest on mortgage obligations and rent and utilities are capped at 25% of the total forgiven amount. And the forgiven amount cannot exceed the amount of the loan. And the forgiven amount will be reduced if the borrower sees a reduction in the number of employees or significantly reduces pay rates.
Okay, thank you, Dave Gelland. Constantine, how can the forgiven amount potentially be reduced?
So, okay, so there's two ways that the forgiven amount might be reduced. The first is if the employer, the applicant, the borrower here sees a reduction in the number of employees, and the second is if they reduce the pay of their employees. So the first one, just in general terms, if there's a reduction in number of employees during the forgiveness period, that's that 8-week period we talked about, compared to at the borrower's election, either February 15th, 2019 to June 30th, 2019, or to January 1st, 2020 versus, through February 29th, 2020, then it could be reduced in that instance. And then the other way is if the employee's pay is reduced by more than 25%, and this latter reduction for employee pay cuts does not apply to employees who see a pay cut when they received an annualized compensation of more than $100,000 in any pay period in 2019. And both of these possible ways of having your forgiven amount reduced can be avoided. There's a grace period through June 30th, 2020, where the borrower can restore employee or pay levels and avoid the forgiveness reductions.
Okay, so if you're trying to maximize the amount of your forgivable side of this, you're going to want to avoid those things, right?
Yes.
Yeah. Okay. All right. So Dave Gellin, take us through a little bit of the loan process.
Sure. So obviously, if not already, you should promptly begin to compile the documents showing the payroll costs as we previously discussed, as shared by David Thomas. You want to identify the participating SBA lenders, and we're seeing more and more that some lenders appear to be giving priority to clients with existing bank accounts with those lenders. You want to submit the application to lender, and the application form is classified as OMB control number 32450407. It's available on the Secretary of Treasury's website, although we understand that some of the banks may have their own form, but it has to be the same information that's contained on that OMB form. So you want to work with your applicable lender in getting that correct application form that they're wanting you to use. You also want to consider opening a separate business account with the lender so that for purposes of tracking the forgiveness amounts, there's a clear roadmap that shows how the money was received and how it was used so that you can verify the costs for the loan forgiveness purposes. And when received, you want to use the loan proceeds for the allowable uses, including the forgivable costs. At the end of the 8-week forgiveness period, you're then going to be in a situation to submit the loan forgiveness request to the lender with the necessary documentation. So if you've taken the proper steps to track the information, to keep information collectively in an organized fashion, you'll be able to provide that supporting information. And then from that point, the lender, as we know right now, will have 60 days to decide on the forgiveness request. And payment on the remaining unforgiven loan amount will be deferred for 6 months from that point.
Okay. So in applying for a loan, are there any certifications that the borrower must make?
Yes, so this is a brief summary of them, and if you go to the actual application form, it specifies in particular, but to apply, an applicant must certify in good faith, and the applicant can have an authorized representative on behalf of the borrower to certify in good faith that there's current economic uncertainty makes the loan necessary to support the ongoing operations, that the applicant was in operation as of February 15, 2020, and paid employees or independent contractors as of that time. The funds will be used to retain workers and maintain payroll or to make mortgage, lease, and utility payments. And what the language suggests is if the funds are knowingly used for an unauthorized purpose, then the federal government can hold you legally liable, including such things as charges of fraud. And other certifications include the applicant has not received and will not apply for another PPP loan. The applicant will provide the lender with the necessary documentation for loan and forgiveness amounts. The applicant will provide the lender with documentation that verifies the number of employees and the dollar amounts of payroll costs, mortgage interest payments, rent payments, and utilities for the given amount, all the items that we described earlier in the presentation, and all information in the application and supporting documents is true and accurate. and not knowingly making a false statement to obtain a loan is punishable under federal law as well. The applicant further acknowledges that the lender will confirm the eligible loan amount using the tax documents the applicant has submitted. And that's some of the basic parameters of what you have to certify when you're making application. And the form is a short form. They say on the OMB that it should take approximately 8 minutes to actually complete the form. But I think the gathering and everything else that goes with it is where the time-consuming part comes in.
Thanks, Dave Gellin. Dave Thomas, can amounts paid to independent contractors be included in the loan amount, allowable uses, and the forgiven amount?
So in the original law that was passed as the CARES Act, it did identify 1099 payments made to independent contractors to be part of that overall payroll cost, which would be part of what would be your loan amount. However, the SBA has come out with some interim final ruling that suggests that, in fact, 1099 should not be made a part of your payroll cost calculation, and therefore excluded from the determination of average payroll and then not multiplied by the 2.5 and so forth. And I think the reasoning behind this is that 1099 independent contractors may apply for this kind of relief themselves based on their own income and expense experience and their own filing of Schedule C. So anyway, 1099s are not to be included in the payroll costs, wouldn't be part of the payroll amount. Now, to the extent that you use any of the funds you receive under the 7A program, you need to use that for your own employees and payroll costs. And I think Dave Gellin identified that at least 75% of the funds that you get needs to be for that particular purpose. The balance of the 25% can be used for mortgage interest, rent, and utilities. Any amounts paid for other operating costs may not be subject to forgiveness, but in fact could be part of what winds up being a surviving loan, again, over 2 years at just 1% interest.
Okay, thanks for that. Have another one for you, Dave. Dave Thomas, what payroll costs are capped at $100,000 for the purpose of determining the loan amount?
So for this, Nat, the answer would be for a salaried person, you simply cap that salaried person at $100,000. And if that's all they get for the year, then that's a pretty easy calculation to analyze month to month. But if you have people who receive bonuses or commissions or much of their pay comes seasonally, then that does need to be analyzed such that no more than $100,000 prorated over the period that they've worked for the organization does not exceed $100,000.
Okay, all right. Dave Gellin, scenario 3, how might the 25% limitation on non-payroll forgivable amounts apply to my circumstances, that is any business circumstances?
So as we understand, no more than 25% of the forgiven amount may be for non-payroll costs. So in other words, 75% of the forgiven amount must be for payroll costs. Therefore, for example, take a hypothetical situation in which the borrower expends $30,000 of loan proceeds on payroll costs during the forgiveness period. The other forgivable uses during that period, namely the rent, utilities, and mortgage obligations in place before February 15th, will be capped at $10,000, assuming at least $40,000 was borrowed. So, if your individual circumstances, the formula used to determine, therefore, the forgivable non-payroll costs is the payroll costs expended divided by 0.75 multiplied by the 0.25. And that'll give you a good sense for what would be forgivable as far as the non-payroll costs.
So you need to keep your eye on that 25% limitation for non-payroll costs then?
Correct.
Okay. All right. Scenario 4, this is for Constantine. Given the reduction of loan forgiveness based upon pay cuts, how can I avoid the reduction penalty while still saving costs?
Yeah, so again, the forgiveness reduction only kicks in there for cutting employees' pay if it's done by more than 24%, if the pay cut's more than 24% of that employee's pay. And again, this doesn't apply to employees who received an annualized salary or wage over $100,000 in 2019. So you can still reduce pay within those parameters. And also as we mentioned earlier, there's the grace period until June 30th, 2020 to restore the pay of those employees and not be hit by this reduction penalty. However, keep in mind that employers may consider restoring pay upon receiving their loan to take advantage of the forgiveness feature for that 8-week period upon the receipt of the loan.
Okay. All right. Thank you for that. And then let's talk about scenario 5. Constantine, this is for you as well. How can I avoid the reduction of loan forgiveness based upon number of employees?
Yeah, so again, you have that grace period until June 30th, 2020 to restore the number of employees and avoid the reduction on forgiveness amount there. Just keep in mind that this reduction penalty will kick in even if an employee or employees quit. So to avoid that reduction, you might need to replace employees that quit, even if they're not laid off or furloughed. Another useful feature, again, that we talked about is that the borrower gets to choose the comparison period for determining the reduction for the lower number of employees there. And again, in order to take advantage of this forgiveness feature and fully maximize the amount forgiven, you might consider restoring the number of employees upon or before receiving that loan.
Got it. Dave Thomas, what other financial relief is available for my business and how might that affect the PPP loan?
Yeah, that's a good question. So I think on an earlier slide, we might have made reference to the SBA's 7B, or their Economic Injury Disaster Loan Program. So this is a more typical SBA kind of loan. It does afford you to apply for up to $2 million at favorable rates. It's not going to be at 1%, but it's generally going to be something around 4% or less. It's available to some of the same organizations that can apply for the 7A loan, but it also would include some other nonprofits that are not 501c3 charities. The thing about this other loan, the EIDL loan that they call it, is as a more typical loan, you're going to have a lot more application processing to do. So you need to have a credit history. You need to be able to demonstrate your ability to repay. For loans over $25,000, there's going to be a potential collateral requirement in addition to personal guarantee. So this is a much more typical kind of loan program. Something that's extremely attractive about this 7B program, however, is that it's loaded with what they call a $10,000 emergency grant. So if you are able to go through the process, and this is directly through the SBA, you do not go through typical financial institutions, you go directly through the SBA. And if you have the time to go through the process and gather the documentation and so forth, at the end of that process, you're able to make a request for a $10,000 emergency grant, which is forgivable and is apparently able to be deposited into your bank within 3 days of the request. So that's a really attractive feature about that particular program. If you do get that $10,000 and it comes to you, then if you do get anything that's forgiven as a part of this 7A program that we're talking about this morning, they are going to include that $10,000. So for example, if they wind up approving you for $50,000 and all of that is to be forgiven, if you also got the 10, then they will only forgive $40,000 of the 7A program since you already got $10,000 free earlier. Okay, that's how that works. Another couple programs, there is the Florida Emergency Disaster Loan that's available for-profit Florida-based companies. It's up to $50,000, interest-free, but it's just 1 year. So you need to get in there, get your $50,000. You need an alternative if you do survive the year and haven't refinanced, it goes to a 12% interest rate. So anyway, that's just a short-term program. And then there are some tax credits that are available for keeping people on the payroll, which is what all of these programs are designed to do, that either lets you get tax credits on future payroll taxes, or in some cases let you defer the payment of payroll taxes until 2021 and 22.
Okay, quite a number of programs that are potentially out there for affected persons, and we're all affected. All right, Constantine, let me ask you something about affiliation and what that means and that kind of thing. How do the affiliation rules apply in practice, and how might they affect a business's eligibility for a PPP loan?
Yeah, so the SBA's affiliation rules are basically there to limit eligibility by treating employees of a business's affiliates as the business's employees for determining its size and eligibility. So the actual language from the SBA regulation says it's focused on control. We have the actual quote there. It's the control or power to control the other entity or common control by a third party. The SBA considers factors generally such as ownership, management, previous relationships, contracts, and the such when determining affiliation and whether there's affiliation between two entities. And just as a way of example here, if a business were to have 400 employees and then it has a fully owned subsidiary with 200 employees, that business would not be eligible for a Paycheck Protection Program loan because the affiliation rules would consider them to have 600 employees, which is above that 500 employee threshold we mentioned earlier. And this is, of course, assuming that the business is not subject to a larger SBA standard size based on its industry.
Got it. Okay. All right. So now we're going to field a few questions from our audience. Again, if you'd like to submit a question, there should be a drop-down screen that will show a chat button, and if you hit the chat button, we'll be able to see your questions. Alternatively, if you can't do that, you can email me at nason@nasonyeager.com, and we'll get to these questions as we can. But let me go ahead and start with the first one. And Dave Thomas, I think I'd like to start with you. If you already have a separate payroll account, is it advisable to continue to use that account?
I don't see why not, Nat. I mean, it's always better if you're able to do something separate specifically for this program in the way of banking. It's certainly going to make it all in one area. So then I would leave it to your accounting department. If you can adequately segregate the funds from an accounting standpoint and make sure you can support how every dollar was spent, I think you're all right. I think the alternative certainly makes a lot of sense. Go to the bank, open up a separate account, and run everything out of there.
Got it. Okay. And Dave Gellin, maybe for you, does the employee have to have been a previous employee to get back to the previous total number of employees?
Based on what we're reading is you don't at this point.
So it could be anybody.
Yes.
Okay. All right. Here's another question we've received. This looks like Dave Thomas. It's going to be best for you, or a good area for you. As a self-employed Schedule C filer, a single member LLC, my paycheck is whatever the net income is of the business. Can the loan proceeds be used to pay me, in effect, as I am the only employee? And if it is shown that the proceeds went to the sole proprietor, does that qualify for forgiveness?
Nat, we believe so at this point, but I tell you, we are going to expect further guidance on that, because while that is effectively going to them as payroll in the 8-week period, as self-employed employees know, by the end of the year, the situation could be different. And so we expect there to be some further guidance on how to measure those who are sort of measuring, and this would include partners as well as sole proprietors. How do they measure the amount of self-employed income, if you will, they have at the end of the year? I think if it's at least as much as they have paid themselves over this 8-week period, they're probably safe. But I do expect a little more guidance in this area.
Okay, thanks. So whoever feels most comfortable on this can jump in. If applying for an EIDL, do I still need to go through a bank or directly from the SBA? Also, as a one-man S-Corp, I don't take a salary, only distributions. Do those distributions count as income?
I'm happy to give it a try. So
Okay.
the EIDL is to go through the SBA, so do not go to your financial institution for that program. You go to the SBA website, and there should be good buttons to navigate through that process, together with all of the payroll information and the historical financial information that's going to support the request for the loan. I think that's the best way to handle it. What was the second part of that question?
Second part is that as a one-man S-Corp, this person does not take a salary, only distributions. Do those distributions count as salary or income?
I think that's going to have an adverse effect on your application if you have not had salary. The only caveat to that might be is if from that S corp you take that distribution subject to self-employment tax. I mean, remember the whole idea of all these programs is to keep people on the payroll, which really ties closely to Social Security and Medicare taxes. And some S corps take their profit not subject to those taxes, and I think that's going to be excluded.
Got it. Okay.
Matt, I think I saw one of the questions also was, in terms of the Florida, what Florida loans are, what available, and maybe David Thomas, I know you mentioned earlier about the EIDL loans, but I think also with the Bridge the Loan program that's out there, maybe you can speak to that for a couple minutes just to let people know, and in addition to the PPP, what else may be available through the state of Florida.
So again, that state of Florida, it is the Emergency Bridge Loan Program. You could navigate to floridadisasterloan.org to find out more about that. Again, this is for the for-profit community only, so you need to be a Florida-based, for-profit, privately held small business. You needed to be in existence as of March the 9th of this year to qualify for that, and to be in what they call a designated disaster area. But at this point, every county in the state is considered a disaster area for this purpose. Remember, it's up to $50,000, so it doesn't go quite as high as some of these other programs. 1 year, no interest, and then if you do not pay it back at the end of the 1 year period, then it elevates to 12% interest. That is an application process. You are going to have to provide tax returns and some ability to, or rather demonstrate your ability to repay the loan. So it's a bit more like a traditional loan.
Got it. Thank you. All right. So we do have a participant, Constantine, that wants us to put up slide 14 again. Well, let's see.
Yeah, I think they're asking about the formula
Yeah.
for loan forgiveness cap on non-payroll costs. So we can pull that
slide
up.
14.
Right. In short, it's the formula used to determine forgivable non-payroll costs is payroll cost expended divided by 0.75 multiplied by 0.25. Again, payroll costs expended divided by 0.75 multiplied by 0.25.
Yeah, and just to clarify, that's payroll costs expended during that 8-week forgiveness period. That's going to be how you base this formula and determine what you can spend on non-payroll costs within the parameters established by the SBA.
Got it. So we're looking at that 8-week period. Okay. Thanks for that. You can pull that back down. And I'm pretty sure those of you who are participating in the webinar that we'll be able to get you these slides if you'd like. And I think our folks are working on that as we speak. But at any rate, so let's see. What happens if you are put in a queue from your lender? What are the chances of getting the PPP loan? Well, I don't know what we know about that. Dave Gellin, what are you hearing?
Well, there's a lot of mixed messaging we're getting. This is all new to the lenders. It's new to the government at this point in terms of how the SBA is doing the mechanics on this. It appears, it is time sensitive. You want to get in front of your lender as quick as you can, get your application submitted. But I think it's right now a wait and see situation as to the timing and the speed in which businesses are going to be getting this. I know certain banks have already been declining, saying they've already met their cap. And I know a lot of clients and friends are searching for lenders. There is a list, I believe, Constantine, correct, on the SBA website as to some of the at least approved lenders right now.
Yes.
Whether or not those floodgates open more and there are more approved lenders, that's another wait and see approach. But I think, start out with the relationship bankers that you have. And if you don't have those, continue to just try to reach out and make contact with other approved lenders and see if you can get in the queue that way.
Yeah, the other thing I said, we had that Wells Fargo moratorium, and then as of last night, the president was talking about supplementing the program. So I think that there's a lot of river to be flowed down before we really get to the final determination of what's available and how quickly they're going to be able to be funded. Okay. So this looks like similar to a question we received a little earlier, but how do individuals who are self-employed and file a Schedule C and do not have any payroll receive the PPP loan? Quite similar to one I think, Dave Thomas, you just answered, but any additional thoughts on that?
You know what? I think if you are a Schedule C and you have books and records of your company, I would simply look at your performance over the past 12 months and see what your sort of net profit has been on a monthly basis. Take the average of that, and that's the amount that you multiply by 2.5 and put it in the application.
Okay, all right. Here's another question. Is there an application and guidelines for the independent contractors and self-employed for PPP loans? In other words, has there been any issuance from the Treasury Department or anything like that on how those will be administered?
Well, I'll take that real quick. I mean, the only thing I've seen so far is that there's been the interim rule that's been produced, and literally as of yesterday, April 6th, there's been a frequently asked questions memo put out by the SBA, I guess through the Treasury. It's on home.treasury, their webpage. There's a Paycheck frequently asked questions, and on that, they don't get into too much detail about, what the IC is supposed to do, but it does clarify that independent contractors should be separately making application versus the employers or the businesses that are engaging those independent contractors.
Right. I think that's one of the clarifications that Dave Thomas mentioned during the course of the going through the slides. Okay, got that. Here's another question regarding tax credits. We touched on that, but Dave Thomas, it asks, or the question is, what tax credits actually are available?
So the tax credits, again, are for payroll, and one of the credits is called the employee retention credit. That credit is available for 50% of an employee's wages that you keep on during a period up to $10,000. So the maximum amount of the credit is going to be 50% of $10,000 paid to that employee for a maximum of $5,000 credit. And that's going to be eligible to be recovered from payroll tax filings that an organization has going forward.
Right. Is that per employee, Dave?
So it's per employee. So if you paid 10 employees $10,000, then you are have eligible credits of about up to $50,000. That's right.
Okay.
Now there are some limitations on that. They have to be have a contraction in their business. They either need to be under an order from a governmental authority that's limiting their commerce, their travel, or their group meetings, or they
perhaps
have
a closure order.
A closure order, yeah. Or they have a 50% or greater reduction in their quarterly receipts measured over the prior quarterly period. And that puts them in this scenario where they're eligible to pay the employees to continue and be eligible for these credits.
Okay.
David Thomas, let me just ask, correct me if I'm wrong, but that tax credit is, you're excluded from eligibility for that if you participate in the Paycheck Protection Program?
That's right. If you're in the 7(a) in the forgiveness program, you won't be able to do that one also.
Okay.
Got it. Good point. Good catch, Constantine. And all right. So next question is, under business address, our tax returns show a PO box. Is that acceptable for the Paycheck Protection Program form, or does it need to be a physical address? Dave Gellin, why don't you take a crack?
Well, it's interesting because on the form itself, it says the business legal name, business address. It doesn't speak to that question. That would be something I would suggest you talk to your lender about, unless Dave, under the typical, Internal Revenue filings and so forth, what do you see in that regard?
Well, on typical filings, you are allowed to use PO boxes from time to time, but I did see somewhere, and I just don't recall, where they were asking for a street, a business street address. And that's also a good point about what the lender requires, because our experience in the past few days has been that lenders are requiring all sorts of things that are sort of on the periphery of what we're talking about, but they have their own forms set up and their own calculations and so forth.
Okay, thanks.
And there's been a lot of questioning of whether or not the banks and the lenders are permitted to sort of go off the beaten path of what the CARES Act and what the SBA has promulgated in terms of the mechanics for this. And so I think that's a wait and see one. Again, we'll see how the SBA responds to what they're learning from how the lenders are implementing these programs.
Okay, so Dave Gellin, for you, is forgiveness guaranteed if we follow the program parameters? Or is there a chance that you spend this money and still have to repay it?
Well, it's a good question. I think, within the parameters of the rules and the certifications and the mechanics, I think if you comply with it and you can show the documentation, I think there's a reasonable likelihood that those amounts will be forgiven. Obviously, this is a fluid process. We keep seeing interpretations, continue to come out from the SBA. Although I have seen that if you've made application, it's the application, the information that's contained on the application will be treated, from what I've heard and seen, as of the date of application, meaning if something changes within the interpretation, I don't think businesses are going to be penalized if something new comes out. Although I do understand that borrowers will be able to update information appropriately as new information comes out in that same regard. So again, I wish we were in a better position to say one way or the other, but it appears that, if you do follow within the parameters that, and you can show the way the money flowed and how it was used, and if it was a proper item that was listed, more likely than not, it should be forgiven.
Okay, thank you. So Dave Thomas, for you, how does a sole proprietor who files a Schedule C calculate their monthly payroll? Do you take your 2019 net income and divide by 12, then multiply by 2.5, or should those people wait for more guidance on the matter?
Well, I think the approach they mentioned is one way to do it. It would be better if one could demonstrate how that income that was determined for 2019 was earned throughout the period. I mean, it may come to the same answer, but if you're able to demonstrate how much your net income is for each of the months in question and come up with the monthly amount, I think that works. But of course, if you've got your 2019 return, your Schedule C, you can certainly determine sort of an average from that number as well.
Okay, thanks. Now I've got two questions that are a little related, and Dave Gellin will direct them to you. This is somebody asking this question. We applied for the PPP through our lender on Monday. They thought they would be submitting to the government by Thursday of this week. Do you have any idea when the government will deposit funds once approved, and will they deposit all of the funds at one time? Related question is, what time frame should we expect for processing and to receive funds after application submission? Should we expect funds directly from our bank or the SBA? David, David Gellin, can you kind of shed some light on the processes that we're hearing about with regard to banking institutions and that kind of thing?
Yeah, both excellent questions, and both, again, unfortunately, surrounding the uncertainties. I mean, I know the government has indicated that money has been made available. It's not clear to us whether that means money has been funded to the lenders, to the banks themselves. And I think it's another one of those, one day at a time, make sure you get those applications in, get in the queue. Originally, we had first heard that, when it first came out, that within a week, you'd be seeing money. We're not seeing that happen at this point, at least those that we're aware of. That's not to say, there aren't situations where it's occurring, but most of the folks that we've spoke with are in the same boat. It's a waiting game. I think it's important to stay in touch with your immediate lender, to continue to stay on top of it. You have to be your own advocate in this process, and I think that's important. And I think, the follow-up, making sure that the people you're communicating with are on top of your file, so you don't get to, sort of lost in the shuffle. There's still this uncertainty as to typical rulemaking. where the SBA would typically, under normal circumstances, have time to issue rulemaking. They've obviously foregone a lot of that with the interim rules and the quick action. And so we are dealing with, our bureaucracy, and that takes time, unfortunately. But I think it's a matter of just staying on top of it and hoping that the funds do start to trickle down sooner rather than later into the hands of our local businesses and people.
Okay, thank you. So for Dave Thomas, can we give raises to existing employees, and will that count for reduction of the forgiveness or for the forgiveness amount, or does the program require salaries to remain constant?
No, you can in fact give employees raises, and I think Constantine pointed out earlier that in the case where you may have actually reduced some salaries or staff in the past several months, there's this grace period that lets you sort of make that up by advancing some of those salaries to people. So yes, you can give salary increases.
And I think
And that's still, but subject to the $100,000 limitation, though, right?
Yeah. Yes.
Okay.
And it's also
Okay.
a timing piece, right, Dave, in terms of when you make those increases?
Yeah, you need to process those soon, and of course it'll be effective for the 8-week period in which you're trying to qualify for the forgiveness.
Okay. So Dave Gellin, back to you. We have another question on the formula, but it's a rather simple one. If you use 100% of your loan proceeds for deferring payroll, you don't have to worry about the 25% formulaic limitation, right?
That's correct. You would have, that would all be money that would basically be forgiven.
Okay. All right. So here's a question. Do lenders have to prioritize by order in the queue, or can they prioritize as they see fit? Dave Gellin, what are you hearing?
Well, it's interesting. I mean, the law speaks to, it's on a first come, first served basis. Now, what that means, you think it means first come, first served basis. To the extent lenders are doing things based upon relationships with the clients, I'm not aware of seeing that. But again, it appears that this is a fluid situation. I don't know if, Dave, you've seen anything of that sort. I'm not aware of, the queue system in that regard of how it's happening at the lender level. But there's certainly, beyond the first come, first serve information, not aware of anything else that we've seen. How about you, Dave?
No, I haven't heard anything else. I mean, I've certainly heard about the frustration that applicants are encountering right now. But we haven't seen how any of the programs have been actually funded. So we're just not sure how they are handling that technically. But you're right, we do understand it to be a first come, first served process.
And again, I think the more organized you are with your information going into the payroll process, I mean, as you'll see in the recent April 6th frequently asked questions, they talk in terms of, who has the burden of the information to verify. And it appears to give a lot of favor to leaning on the borrower and allowing the lender to rely on what the borrower is giving them as sort of an acceptable default, versus having the lender to go through its separate independent process. And I'm also seeing that, if you have like a third-party payroll company that does your payroll, that also is being viewed as appropriate documentation, which would be sort of acceptable and have less, for lack of a better word, scrutiny, that if you're kind of piecing together information. So, when you ask the question as to the speed and the order, I think it's really going to come down to if you have a clean application, which has all the I's dotted and the T's crossed, where there's going to be a lot of back and forth checking on documentation. The law and the SBA has made it clear that they're trying to make the process as streamlined, as simple as possible for applicants and for the lender to be able to process this. So I think the better that you, again, being your own advocate and being vigilant and getting the information compiled and submitted in a way that the certifications line up, perhaps that'll move your application on a more expeditious basis. But again, we haven't seen any evidence either way as to the results of that activity.
Okay. Dave Gellin, let me stick with you for this next question. Does the program require the business to experience hardship during the eight-week period? If so, what proof of hardship would be required?
I don't believe that you have to actually, you make there's sort of a presumption that if your business is in existence right now and you're experiencing everything that's going on with the pandemic, that is sort of prima facie an acceptable level, but you have to certify it to that end. But I don't believe there's any currently information out there that suggests you have to do anything more than that. It's just another certification that that there's current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. That's one of the second tier of the certifications that we spoke to. For the process.
Okay, so this next one's for you, Dave Thomas. If you are an S Corp and receive distribution income and file a K-1 reconciliation worksheet on your personal taxes, can you include the distribution income as part of the payroll?
We don't think so right now, Nat. Again, it goes back to what is deemed to be self-employment income. And so I don't have specific guidance from them on that, but we see if there are salaries paid to yourself. And by the way, the IRS has long been encouraging S corporation shareholders to include themselves as wage earners and get compensation to officers, one of the top lines in the return. And we think that's what counts. Payments made to employees and payments made to officers and shareholders as wages.
Got it. All right. Constantine, I think this would be a good one for you, perhaps. Documents state that you have until June 30th to restore your full-time employment and salary level for any changes made between February 15th through April 26th. Does that mean if you have laid off any employees during this time period that you will need to rehire employees to equal the number you let go?
Well, I wouldn't say you need to, but for the purposes of avoiding that loan reduction penalty, the forgiveness reduction penalty that we talked about in the slideshow, yeah, it would be a good idea to get back to your normal levels in that time frame by June 30th, and that's to avoid getting less of it forgiven and treated essentially as that tax-free grant we talked about. So yeah, I think that's the best way to look at it. We also talked about maybe even restoring earlier to the extent you receive the loan. At that time, that's when the forgiveness amount is determined. So the higher your payroll costs are during that forgiveness period, that 8-week period, the more will be forgiven. So it would be a good idea to consider restoring your pay levels and your employee levels before that time.
Yeah. And keep in mind, Nat, you mentioned earlier that we just heard word that there's rumblings in Washington right now as to possibly another stimulus package. So it's going to be important while this is what's in front of us right now, to really keep your eyes out and ears open in terms of what's going on with perhaps another stimulus package, which, you may want to decide, as more information comes out, what is the better timing for dealing with the employee count and what's going to be obviously during the 8-week period, but perhaps there'll be lessons learned from this stimulus package that perhaps may address issues that, maybe have a catch up or something. I don't know, but if there's another round of funding.
Okay. So here's one I received on my email. This will be for Dave Thomas. I pay my workers in the form of 1099. In other words, this person has all independent contractors who work for them. Can I still apply for the PPP program to pay for these workers?
And I don't see that as being eligible. Again, the original CARES Act is drafted in the House Representatives bill included 1099, but the clarification from the SBA said that 1099 payments are not to be included in payroll costs.
And essentially, one of the things I think you said was one of the reasons for that was that otherwise it created the possibility for double dipping, right?
That's exactly right. So each of those independent contractors will now file or potentially file their own claim under 7A.
Got it. Okay. Here's a question. Dave Gallen, I'm going to start it with you, but there's got a lot of tendrils we can go with on this one. It's a good question. We own two businesses, one that has employees, and we have applied for a PPP loan. The other company is one we formed as the owner of our building. So there's a lot of people out there that have done this. They've got a building that they own in a separate company, but yet they house their business out of that building, and that's a separately owned entity. So given that structure, that particular building owning company has no employees but does have a mortgage. Can we apply for relief for that company? And if so, what is the best program to try? Dave Gallen, I'm going to start with you, but Dave Thomas, be ready to step in because I think you might have some thoughts as well.
So I think it goes back to when I first was speaking about the slide presentation, the difference between what the proceeds can be used for versus what's forgivable. And I think under the facts that you've described, there's a couple scenarios that you could consider. The first is that separate company that has a rent obligation for that office building could make application for monies under the PPP. However, it's unlikely that those costs would be forgivable. Those monies would be forgivable because it's not dealing with payroll costs. Alternatively, I think an analysis should be considered as to the affiliation between those two companies under the affiliation rules and whether or not perhaps application could be made sort of as the co-ownership and therefore then combine the payroll costs with the mortgage costs. And then you'd still be subject to that 25% cap, but that's something to consider. Although, a lot of the lenders, and this is where it's talking with your lenders, having transparency, full disclosure with the lender and that you're dealing with to explain your situation. Again, there's a lot of different rules relating to the affiliation, common ownership, who makes applications. So I think there's different ways in which that potentially could be addressed, depending on how the lender views that relationship. Again, if there's a history of funds being used based on revenue and how that money gets paid to pay for that rent, these are all questions that I think should be analyzed as you're going through the process. Dave Thomas, Constantine?
Yeah, so my concern for them is really on how much they're going to be able to get as a loan amount, and they'll have the payroll costs from the initial entity that they talked about, and that'll be the basis on which they make application, and they get 2.5 times that. Of course, whether that amount is used for payroll or some other purpose determines what's forgivable or not. But to the extent that they feel limited, I think make application for under 7A for the company that has the employees and has the payroll to support all that amount. And then for the company that simply owns the real estate, well, you could consider the 7B, the idle loan, or even the Florida bridge loan, but you're going to have to be able to provide guarantee, collateral, tax returns, ability to repay. You're going to have a lot of information to get that money. And then if you do, of course, it's relatively cheap, if not free. The $50,000 from the state of Florida would be free for a year. But anyway, none of that's forgivable. So those are just loans to the organization under those programs.
Okay. Before we leave this subject, let me go to Constantine. Constantine, could the affiliation rules be used to help people in this situation?
I'm not sure if I see a way that they can be used to really help people. They're really there just to determine eligibility. So it's the idea that, are you qualified as a small business or otherwise eligible to receive this relief? And so, yeah, I mean, it's more focused on that and determining the size of the business for whether they're eligible, more so than hey, you're affiliated. So, and we're seeing that, in some instances, you could make the case that, hey, you should be able to consolidate your entities if they're under the 500 combined in order to make an application. But what we're seeing is certain lenders are requiring actually that you kind of break down your subsidiaries in order to make these applications, because they want to just look at the tax ID numbers, the payroll, whichever entity is paying the actual payroll to employees rather than looking at the big picture. So that's what we're seeing.
Got it. Okay.
And I think that filters back to the same thing about, streamlining the easier you can make it on the borrower side for the lender to get your application. So you don't want to be penny wise, pound foolish and try to get more than potentially you would otherwise be entitled to. And so I think it's probably more prudent to focus in on your specific needs, because this really is designed to help the nation's small businesses and these 500 or less numbers with dealing with payroll and keeping their employees getting some financial support. The other thing also is on the affiliation rules. I just point out under the recent April 6th frequently asked questions, they talked about the affiliation rule based on ownership. And one of the things that they say that the SBA will deem a minority shareholder in a business to control the business if the shareholder has a right to prevent a quorum or otherwise block action by the board of directors or shareholders. But if you irrevocably give up those rights, it's considered not to be an affiliate of the business. So they're basically saying if a minority shareholder in a business irrevocably waives or relinquishes any existing rights that are specified in certain the Code of Federal Regulations, the minority shareholder would no longer be an affiliate of the business, assume there's no other relationship that triggers the affiliation rule. So a lot of businesses are looking at that so that they're not unnecessarily deprived of perhaps getting assistance and support under these programs because of some affiliation that their minority owners may have.
Okay, got it. So I want to thank everybody who joined us. I hope you found that this was a worthwhile seminar. I particularly want to thank Dave Thomas from Hollyfield and Thomas, and obviously my partner Dave Gellin and Konstantin Chitakis, who is a fantastic associate with us. You all did a great job getting up to speed on this. This is a fluid situation, and we hope to continue to present any updated information to you all in this or similar form as we progress through this. But we all are in it together. We'll get through it together, and again, we're going to do what we can in order to try to get out these slides or maybe some useful information to you in order to guide yourselves through this. But I also want to say that Dave Thomas is available. He's got really great accountants over there, as are Dave Gellin and Konstantin and myself for that matter, in order to assist you all in trying to navigate through these choppy waters. But once again, we'll get through it. Thanks for your time. I hope you all found this to be a worthwhile hour, and I hope you leave it with a little more knowledge than you came in with. I know I did. So thanks.